About a year ago, we released a SimpMe video that broke down the concept of a SPAC, also known as a Special Purpose Acquisition Company. For those who may have missed the video, SPACs are investment vehicles that are essentially shell companies that are used to take a company that was previously privately held public. Now you may be asking yourself, why would anybody create a SPAC if they could follow the traditional initial public offering process? Well, one of the main reasons SPACs became increasingly popular within the market a few years back is because IPOs are expensive. There are a variety of parties involved in the IPO process. There are legal fees, investment banking fees, and SEC filings that companies must handle when going public. However, the SPAC model eliminates the costs that companies would normally incur when going public. In addition, SPACs require investment sponsors who serve as the party to raise capital from a wide variety of investors. These investors are then expecting the SPAC sponsor to acquire a private company within a specified time frame. If the sponsor is capable of identifying a company that is willing to be acquired and taken public, this is a huge win for the SPAC sponsor. The financial markets have officially cooled down and have unfortunately taken a turn for the worse over the past few months. Inflation, war, supply chain issues, and the geopolitical climate have caused the market environment to tighten. Money is not flowing through the financial system as freely as it was during the height of the pandemic and quantitative easing. CNBC recently reported that approximately 27 SPACs have been liquidated by investors, totaling $12.8 billion. So this is where things get interesting and more context can be provided to further understand this change in the tide. The government recently passed the Inflation Reduction Act to combat this drastically rising inflationary environment, and one of the key provisions within the act could cause SPAC sponsors to pay a 1% excise tax if the money they raise from investors is not returned by 2023. Many of the largest proponents of SPACs like billionaire Chamath Palihapitiya and Bill Ackman have described the market conditions and volatility as major contributors to this decrease in demand for SPACs. Time will indeed tell if SPACs make a return when the market turns around. However, IPOs could be more viable for savvy investors that are looking to gain strong returns on their investments. So I hope you all found this segment of the SimpMe Says series interesting, and be sure to stay tuned for more content at www.simpme.com. Thanks.